we believe it's early morning there in France, right? So thank
Yeah,
you for
but right
joining
now
us.
it food is 6:25,
Okay.
so it's better than
Okay,
5:35.
so I would like to introduce Dr. Aref. Dr. Aref Madhapiar Dekani is a doctoral fellow at Université de Paris 1, Patong Sorbonne, France. He also is a visiting professor in banking at Université de Limoges. So he earns a PhD from University de Limoges. To Dr. Aref, you will have 30 to 40 minutes also to deliver your material, and we will continue to Q&A session. So the time is yours, Doctor.
Thank you very much, Dr. Pucha. First, hello everyone. I hope you are fine and safe. And so I would like to present the slides that I prepared. Actually, I prepared for 75 minutes, but right now I realize that it's 30 to 40 minutes. So I will try to shortcut from some parts. I apologize in advance, but I have to make it short. Okay, so here, just first let I share my slide with you. Share, okay, share a screen, and it's here. So let's see how I could make it okay. So do you have my slide right now?
Yes. Could you put it on slideshow mode?
Yeah, I'm trying to do that. Wait. Okay, I think that is okay.
Yeah.
Okay, so this is the introduction to the crowdfunding platforms. And first, what is the first and very simple definition of the crowdfunding platforms? Actually, it's direct matching of the lenders and borrowers. So that is the simple and main definition of the peer-to-peer lending. Actually, when we are dealing with a bank, so it's not very transparency for the in the view of the lenders and borrowers, because, for example, the lenders are the depositors. They put a deposit on the bank, and they do not know that how their deposit would actually fund some of the projects of the investors, because they do not have any information about the investors. And also investors, they do not know who is the lenders to them. I mean, who is the borrower, and something like that. There is really not very visibility here. But lending-based crowdfunding platforms or equity-based or all those things actually are the links. So in that case, investors could see directly the borrowers and could choose from the borrowers actually. And also borrowers could see the investors. So that is something that is very transparent in one way. Also, after I will talk about some disadvantages and also something else. But that is the simple definition of the peer-to-peer lending. So what is the emerging point of the crowdfunding platforms? Global financial crisis, although it has devastating impact on the financial system and economy, but also it has the turning point to the growth of innovation. I mean, when the banks and financial institutions, they see that already they lost the profits and the customers and so many things actually during the financial crisis. They try to reduce the cost or do something actually, make some innovation in order to again actually keep the skin in the game. So the first let's say the first innovation was the internet banking. So following the margin of the banks forced them to close their branches either globally or locally, and in that case to reduce the cost and increase their profit, they offer the production through and the services through the application of the internet banking. Also, before the crisis, we had the internet banking, but it all, I mean, the banks only offer the limited services through the internet banking. But after financial crisis, banks began to either offer some other services that before it was only services in branches. So opening the account, closing the account, and application for the loans, for the insurance. So most of the services that banks offer usually through the branches, also they provide it with the internet banking. In the second stage of the development, actually crowdfunding platform has emerged outside the traditional financial system. And why I say outside the traditional financial system, because the business model and the business plan of those platforms are really different from the banks and financial institutions that during this course I will try to mention some of them. So we have a three main type of the crowdfunding platforms. So we have a loan-based crowdfunding platforms to the consumers and also to the business and SMEs, that we call it also peer-to-peer lending or marketplace lending. Another, we have a security-based crowdfunding platforms in both debt and equity side. And then after, we have a reward-based crowdfunding platforms. So I will try to describe shortly, I mean, the two of others, because the focus of this course is on the peer-to-peer lending, but to our knowledge, I will say very shortly something about the both security and reward-based. So the security-based crowdfunding platforms actually allow firms to raise the capital by selling the securities through these platforms. So actually, those kind of securities could be share convertible shares. I mean, could be shares, convertible note, debt, revenue shares, and some other type of the shares and bonds, and so the firms try to find the investors for the equity and debt to those platforms. But one interesting thing is that those firms shouldn't be listed firms, because when the firms are listed, they have access to the capital market. They no need crowdfunding platforms. Okay, so everyone could find that shares and they could trade that shares. So in essence, actually, there is no need of the crowdfunding platforms, because they have the investors, and everyone could buy and sell the security very easily. Very small firms or very small firms, young firms, and all those firms that actually do not have enough access to the credit market and capital market like a listed firms. So in that case, what is the option for very young firms, for very, I mean, for young firms, or for, let's say, small firms? What is the option for earning the capital, for actually for selling the debt or capitals? Actually, the first is they could finance the project if they want to do it by equity, or they actually could finance the project by themselves, or actually or borrowing from the friends or family. But here is that they have limited access to the people, because the network are not so big. So even if you know the friends, they will ask, okay, my friends, if you know someone that who could come and invest, please tell them to come. They do not have enough access. Make you visible, make your company visible, and will give you the opportunity in order to lots of investors see you and look at your project, look at your company, and they actually help them to come and invest on your project. And also you could meet lots of investors, because, for example, if you talk about the equity is something that if someone invests on your equity, that person could be your it could be the partner of you. So in that case, it should be also important for you as a firms that who will be your partner. So in that case, also you as a borrowers, I mean, you as a firms, you have the visibility of seeing other people and investors that they come to invest in your project. Anyone can come and invest in the equity. platforms. So investor in equity do not participate only to buy the shares or share the money or actually give the receive the profits, but also they are looking to take the profits of all your company because they are right now shareholders. So in that case, actually what is interesting is that the people who invest through these platforms, they are looking for your success. And then after, because they know that after you have successful business, they could earn much more profit. Yeah. And another thing for the firms is that when they try to use the security-based crowdfunding, either debt or equity, they know that it's not only to financing their project, but also they will find the brand ambassadors. So those people who come to buy the equity and shares of that company, they could be as a brand ambassadors. They could advertise your products to the other people. So you will find a very large amount of audience for everything, for all the reason. If you see here, is a breakdown of type of securities that actually trade in the crowdfunding platforms, equity and debt. So what you will see is that in 2018 in US, of course. So the higher share is for the common stock, that is 30%. And you will see that mostly in the security base, they trade the common equity. And then also you will see the other revenue shares, membership units or convertible notes and others, and debt also, and safe. Safe actually is very safe security, so like treasury bills, so something like that. Okay, so how it's work, this security-based crowdfunding. So investors, the people who come in order to invest in the project, they have an opportunity to come and support the entrepreneurs in the website. So they will come to browse the campaign. So what is that you are the investors, you will go and to the platforms, you will see the platforms, and there are lots of company there, and you will go and see the description of each company. You will see that, for example, the company say, okay, the name of my company is the characteristics of my company, and I want to work in that project. And usually the firms will write everything about the firms, about the project that they want to finance, and also all the necessary information about their financial accounts, or also financial statements, and everything that is necessary for investors to know. And then the investors, they will evaluate the development, the stage of the development of the company and everything else. And they will decide in which company they have to invest. And then they will fund the project. So for investors, it's possible to invest in so many different companies. And in that case, they could have a good portfolio management if they invest in the lots of companies from a different perspective, so they could optimize their portfolio. Another one is a reward-based crowdfunding platform. So in the reward-based, actually the investor's intention is not to receive the money, is not to actually gain the profits. Is to mostly they actually, the purpose of the investors are donation. Okay, so let's say that one person are living in the region that he care about the development of the region, and there is a company in that region, and he want to donate the money to donate the investment to that company. Or let's say they actually they have some for example, during this COVID crisis, there is several small firms, SMEs, and some others that they are working on developing the medical cares for that COVID. So everyone tried to donate the money through this platform to those companies. So that is something that the reward base is working. And the SMEs or the firms in the reward basing what they give instead of the money they will receive is, I mean, giving some certificate or a small product with the name of that company, and they will write the name of the donators and will give to them actually as a product. So that is something that the investor will receive. Okay, so if you look at this graph, actually we realize this graph is about the development of the investment in the debt and equity-based crowdfunding platforms in European countries. As you will see, I mean, the UK is really totally largest platform, largest country in the crowdfunding platforms, but because it's not anymore in the Europe, so we will see other country. So as you will see, the France is a leader of the peer-to-peer lending and crowdfunding platforms. So, and the least one, actually the small one is Poland. I cannot see from here, but I think you will see. And okay, so so peer-to-peer lending, as I told you before, it is a way to match directly lenders and borrowers. The first peer-to-peer lending in the world was Zopa UK in 2005. And then after, in the next year, we had the first US platforms prosper in 2006. As I told you, global financial crisis was a turning point. That means that before that, we never had a crowdfunding platforms. But after the global financial crisis, everyone thinking about that. During that time, we had only 2 or 3, maybe, or 4, but they are not very famous and popular as after financial crisis. If you look at the statistics, in 2015 in UK, 12% of the new small business loans originated from the platforms. That is really, high statistics. I mean, 12% of the new small business loans in the large country like the UK, that is really considerable amounts. And then peer-to-peer lending platforms offer credit through internet and relying on the new technology and big data to assess the credit risk. So why they rely on the big data and new technology? So sometimes there's a question here. So you may ask yourself that why they use some technology that bank never use. I mean, bank common, that is bank they should use all the technology that they can. The difference here is that for banks, they have a regular customers. So the firms that allow to come and ask banks the loans and would accept it is the banks that they have a credit history. Okay, so the banks knows that firms, they have a lending relationship, they have a credit history from that firms, and in that case, so it's very easy for them to evaluate that firms. But peer-to-peer lending platforms, usually they work with the firms that they do not have enough credit history. So they have to use the new technology to capture the soft information, because the bank usually use the hard information, also sometimes soft, but usually peer-to-peer lending platform focus for the credit rating and credit scoring is a soft information. Soft information could be the data from the social media or the data from the other website that they could actually use the big data in order to scrap the data from the social media or other websites. So in that case, the combination of both soft and hard data and using the technology and the big data and other things could be helpful for the platforms in order to assess the credit performance of the firms. So here is also here is in 2010, actually is the ranking of the platforms, I mean, in the world. So as you will see, the first 3 are from US. So we have Virgin Money, Prosper, Kiva, and then the 4th one is Zopa. And we have from other countries in 2010, but the majority of those crowdfunding platforms are from US. And you will see the trading volumes I mean, in the scales of million US dollars in front of them. Okay, in order to uh, realize better how the peer-to-peer lending works, it's better to back to the definition of financial intermediation, to look at the uh, crowdfunding platforms through the eyes of financial intermediation, and to compare to see whether they are similar, they do the same thing, or they are different, or totally different, or what could be happen here. Okay, so for that, we have to know what is the main function of the financial intermediaries. Okay, we have two main functions. The intermediary have a brokerage rules and also maturity and risk transformations. So brokerage rules is very simple, connecting the lenders and borrowers, okay, and receiving the fees because of that connection. Okay, that fees could be something like a service fees, or I don't know, the connection fees, or financial advice, or something else. So actually brokerage rule of the banking and financial intermediation is the connecting of two different agencies with the two different needs, let's say borrower and lenders, or the borrowers and depositors in the banking and financial institution. So in that case, financial intermediaries, they have to develop a specific skills to interpreting the signals of the quality of financial assets, like the loans or something like that. And in that case, they could avoid the costly application cost of the screening and reusing the information. So how is possible to reusing the information? Because they have a regular lending relationship with the firms and the borrowers. So in that case, they will actually every time in the dynamic way, they will monitor them, and then they will store the data, and every time they want, they can use those data and reuse those data. And also they will assign the credit score for each customers based on the technology that they have. So that skills actually will develop day by day, month by month, year by year, um, for the financial intermediaries. So that brokerage activity, as I told you, is transaction services. When you want to actually wire your money, the transaction services that the banks will receive, financial advices, screening and quality and certification of the quality. It is those brokerage activities that the financial intermediary usually use. And also, I mean, that is a brokerage job of the financial intermediaries. The second important job is the risk and maturity transformation. Okay, so what it means that they have to, the banks usually, or financial intermediation, they usually fund the long-term and non-liquid assets like loans with a short-term and liquid asset like deposit. Liability like a deposit. So the loans is asset, and the deposit is short-term liability. So these two have a different maturity. So the loans is a long-term maturity, mostly 10 years, 20 years, 30 years, but the deposits are very short-term. It's let's say every time is often the request they can receive the money, and also with a different risk. So in that case, by matching these two, financial intermediaries actually transform the risk and also maturities. By doing that, they also create the money. But the question is that, do peer-to-peer lending platforms do the same job? Do they have both brokerage? Do they have brokerage activity or maturity risk transformation, or both of that? That is a real question that we need to respond. But before that, it's good that we look at the flow of the funds in both banks and peer-to-peer lendings. If you see here, in a bank, The banks actually connect the lenders and borrowers through its own balance sheets. Okay, so that balance sheet is a place for the risk and maturity transformation, and also is the place for the brokerage activity. Okay, so everything happened between the lender and borrowers in the banks are through the balance sheet of the bank. So we have here the balance sheet risk for the banking systems. Why? Because usually the borrowers and lenders, as I told you before, they cannot meet each other. So here banks actually give the deposit insurance to the depositors. So depositors never need to monitor the lenders, the borrowers, sorry, and the borrowers, they never see the depositors. So everything would be happen is inside the balance sheet of the bank. But for the peer-to-peer lending platforms, as you will see here, we do not have the balance sheet. So it means that those platforms never use a balance sheet. So they directly connect the lenders and borrowers by receiving only a fee from both sides, lenders, borrowers. Sometimes it's different with the platform. Some platforms receive only from one part, or some platforms receive from both parts. So only they will receive the fees and they will issue the loans to the both side of the market. So they do not have the balance sheet. But one thing I want to tell you, that is different business models. In one country, maybe they also could use a balance sheet. They could have the secondary market. Okay. By the way, in France, still in the France, because we are working the project here in the France, still we do not have any secondary market. So it means that they only will receive the fees from the lenders and borrowers. There is no secondary market here. So in that case, the only financial intermediary rules of that are only brokerage and not risk transformation and maturity transformation. But in some countries, yes, we have that. So, but not as developed as banking business plan and business model. So let's move to the business model of peer-to-peer lending. So crowdfunding platforms create a value by connecting the lenders to borrowers. And as I described for you, unlike banks where depositors cannot see the lenders, there's a possibility for retail investors to choose the borrowers in the crowdfunding platforms based on their need, based on the projects, and this decision of the investors to finance the borrowers, it's by analyzing the risk and return through the information that the borrowers provide for the investors in the page in the crowdfunding platform, and the objective of the project. And it's not only about the, let's say, about the project or about the risk and returns, but sometimes also there is some moral perspective, that is some things that is moral for the investors. For example, we have some investors that they care too much about the green environment. Okay, so they want to invest in some green products, even though maybe there is less return for those products than other products if they want to invest. But he or she care about the green environment. So here the returns are not very important as the object of the project is important. Okay, or some people or some investors are looking for the project that are socially and environmentally responsible. So everything is not. Also, something is very interesting is that, mostly the crowdfunding platforms are attracted to local investors, the investor who they want to invest some project in their own region, okay, to develop their region. So for example, if some investors see one project with a less return, it's already want to organize in or establish in their own region, the region they are actually living. And there's some some other project with a high rate of return, but in another region, maybe that investor will come and choose that one in his own or her own region because they want to help the development of the region. So there are lots of factors that investors usually in the crowdfunding platforms, they are considering to actually invest on the project. So the minimum usually investment per project is start from 1 to 20 euro in France and in some European country. So lender can actually make a portfolio and invest in lots of projects. So in that case, if one lender's one borrower defaults, so they could actually get less lost by receiving the money from the other borrowers. One thing else that I want to add here is that unlike banks that provide the deposit insurance, here in the crowdfunding platform, all of the risk will borne by the lenders. So if the borrowers cannot actually give back the money, cannot pay the money back to the investors, in that case, the investors are the only persons that they have to bear all the risk by themselves. So for that reason, they should be really careful about optimizing their portfolio. So they have to choose between the firms in order to reduce the risk of defaults. Another fact is that most of the platforms do not invest in the actually projects and the firms that they come. So that is something we call it. They do not actually put their skins on the game. So in that case, there is not a good signal to the investors. They say, okay, even the platforms, they do not invest in their own projects. So how we could find that it's really high quality borrowers and firms are there? But sometimes some platforms actually, in order to gain the trust of the investors, they will come and they will invest in some of the firms and projects in their own platforms in order to send a signal to them to say, okay, let's see, we also invest on our project. So it means that they're safe because the credit rating that we gave to them is really, really actually real. And as I told you, credit risk is borne by lenders. So platforms, they only generate the profit from the originating and service fee they will receive from the borrowers, from the lenders and borrowers from both sides. And also it's similar to the Airbnb, Uber payment cards or something. So they are two-side markets.
I'm sorry, Arif. You still have 2 minutes to 3 minutes. Thank you.
Okay. So let's see that. Okay. Sorry, I have to finish it very soon. So here we have an egg and chicken paradox. Okay. So it means that the borrower decision to apply for the loan in the platforms depends on how many lenders are there, and the decision of the lenders to come and invest in the loans are dependent on how many borrowers. So these things are like an egg and chicken paradox here. So the quality of lenders and borrowers is really matter for making the business in our platforms. We cannot say that first borrower will come or first lender. I mean, as much as there's a platforms with a lot of lender and borrowers, that would actually perform much more investments. Okay. So one thing I want to tell you, I mean, the last thing I will try to finalize everything is that let's say this business model of peer-to-peer platforms is applied to the number of distinct specialized lenders. So we have a peer-to-peer consumer lendings that they only lend to the normal people, consumers. We have a Zopa, Prosper, Lending Crop. There is the name of the platforms. While another platforms are specialized to lend to the SMEs and firms. We have Funding Cycle or Uniland. and actually also we have some specialized crowdfunding platform. Some of them are provide property security lending to properties. Others offer the possibility to SMEs to sell their invoice to the investors or invest in the clean energy projects, or several platforms allow businesses to sell debt-based securities. Okay, so let's see that. Okay, so one thing from this slide I want to mention that's very important is that sometimes we will think that the platforms actually will take all the customers that they are not able to fund from the banks. They are not able to get the loans from the banks, but actually it's not very true, because in France, what we realize is that also those firms that they will come to apply for the loans, from those firms, also 90% we have a rejection rates from the platform. So also they reject, a lot in the population. And one thing else I want to tell you is that depending on the business model of peer-to-peer lending, platform can engage in the other brokerage activity, such as loan origination or something. But the three business model we have in the platforms, they are totally different based on the actually aggregation and inclusion of the banks in the system. Do I have a time to I talk about these slides?
1 minute.
Okay, so that is great. So that 1 minute is enough for me. So first, we have a client segregated account model. So in that case, everything would happen through the bank. So the borrower's has an account in the bank, the lenders has an account in the bank, and the platform is only connector. Okay, so everything will happen through the banks. Banks issue the loans, and the lenders and borrowers will work through the banking loans. So it is the lending platform is only the window. Then we have a notary model that once the funding goal is met, the banks will originate the loans and platform will issue the notes to the lenders that reflect the amount that they actually pay to the borrowers, and the borrowers will repay the investors to the banks, and the banks will transfer the money to the platforms, and everything will be happen like that. And the third and last one, we have a guaranteed return models. So in that case, the platforms will do everything. So the banks has really very less rule in that system. So as I told you before, there is no creation of the money here in the platforms in all these three. And just to summarize, just to say it very fast, for the pricing online loans, we have a centralized control of the loans and auctions. So there's two main pricing model for the loans. In the centralized, actually, the platform will put the credit rating, credit score for each borrowers, and then after the lenders will come and see and then the borrowers could select how much they want based on the score that they have. So everything is related to the score that that crowdfunding platform will give to them. So investor will, the borrowers only have the option to choose among those available and limited options that crowdfunding platform will give to them, and the lenders could select that. But in the auction, also the platforms will give the credit score to each borrowers, but also the borrowers could give their own price to the market. And in that case, the investors will bid on the price. So the investor also will say that how much they are willing to pay and what is the rate of the investors. And the minimum amount from the investor will be chosen and will give the money to the borrowers, and the borrowers will repay on the minimum amount that they will choose. So, okay, so I guess that's, I think I will finish here. And I hope that it was enough.
Thank you very much, Dr. Aref, for your spectacular presentation. And now I will open the Q&A, but because we have a limited time, I will choose 3 questions from the chat box window. So first question addressed to Bapak Januar from Cairo, from Universitas of Indonesia. How, Pak Januar, Bapak?
Yeah.
How does Dana Didik measure prospective borrowers' employability? And how does the institution avoid unnecessary bias in determining the employability of the borrower? Thank you. We hope that you can answer with a short and concise time. Thank you very much.
Okay. I will directly answer that. Basically, we have already have the data that which fields of studies that can work very fast. As you can imagine, like this, in the for if you take majors that not after you are graduate, you have a lot of persaingan ya, a lot of
competition.
Yeah, a lot of competition out there. Then we will not work in that field. For the last 2 years, we already know with fields that we will concentrate. We are concentrating in healthcare in the last 2 years. We are concentrate in health workers, and when the pandemic is arise in Indonesia, then we are very sure that we are in the correct fields. Because in Indonesia, health workers, besides doctors and for Indonesian, one health workers must serve 10,000 people. So the Indonesia is lack of health workers, especially in this period of pandemic. That's why we are now, since the last 2 years, we are concentrating in health. For other fields, we will look case by case for your. You can imagine, like we are working with lembaga pelatihan kerja which sends people to Japan. They just need the loans only for certification. After they get the certification, they can work instantly and they will repay the loans immediately. That's how we are looking the fields. So we are very strict and case by case, and from our experience, basically like that.
Okay, thank you, Pak Januar, for the answer. Yeah. So the second question addressed to Dr. Arif Madavi. So it's from Aldi from Universitas Indonesia, from Indonesia. So in regards to the implementation of equity crowdfunding platform, is there any legal protection that accommodated by the platforms for the investors in case that the company or the project which received the capital from the investor through the platform is collapsed? So how are the liability of the equity-based crowdfunding platform actually works?
Well, actually, it's very similar with the loan-based crowdfunding platforms, at least in the Europe, in the France. Maybe in the different countries, different, but there is not such a high protection from the platforms. Actually, when the investor will come and invest their money, they actually, at the beginning, they have a right to see all the information from the firm. So they have to decide about that. So it means that there is, at least here in France, we don't have any rules and regulations or any protective staff for those firms, for the investor. So what here is that the only thing the platform usually do is a promise to send I don't know, notification to the borrowers time by time, recall them that you have to pay. And or sometimes, for example, but some of the platforms also they will try to invest in some of those firms. In that case, also they would be one part of the interest. So they will try to do some legalization, but generally not such a very protective actions. Usually the equity crowdfunding platforms will do here in actually in the country that I'm working on that.
Okay. So the third question also addressed to Dr. Aref. So from Gusti from Indonesia, he wanted to ask about your opinion to gain the lender trust, how to gain the lender's trust, and how we as a lender trust the borrower to lend them to support our project or businesses, or choose the right borrowers. Another way as a lender, not like a bank like Mr. Arif mentioned before.
Yeah, sure. Wait, one thing first I want to tell is that we have to accept that the business model of crowdfunding platforms is totally different from the banking system. Why? Because first, when you put your deposit inside the bank, actually in Europe, I think also in Indonesia should be same. Never pay a lot of interest safe. It means that okay, that actually is my job. So it's somehow some sort of the rent-seeking actions of the bank. But when you wanna lend, actually because you want to take a risk, investors, because you want to take a risk and go and find the investor. So right now the question is that how you could find the safe borrowers and how you could trust to that borrowers. One of the things that the crowdfunding platform could do, as I tell you in the course, is that to actually they play the game. So they also invest on the firms. In that case, they could show the quality of those firms. Okay. By the way, they also provide the credit rating. So that credit rating also will help you. So based on the credit rating that the platforms will actually publish in the website, so you will know the safe and not safe firms. So in that case, the interest rates are different between safe and not safe, the investors. So some investors, they want much more money, so they take a risk. So they will go and invest on the company that they have a lower credit rating. So in that case, that is something on the hand of the investors. But to attract the trust of the investors, actually the platforms, the only thing they can do is to offer investing on the loans by themselves or equity by themselves, and then offer some other services in order to help the legalization of any default that would be happen on the market.
Okay, thank you very much, Dr. Arif, for your answer. So unfortunately, we have a very limited time for this session, so we have to end this Q&A session. So, but we receive a lot of questions, and we will accommodate all the questions and send it to Bapak Januar and Arif, so we can send it the answers of them to your email, to the students' email. So if it's okay, for
me,
and Arif,
it's okay. Maybe I will put my email in the chat, so everyone can send me an email for a question.
Okay. Thank you, Pak Januar and Dr. Arif. So for all students, it's time for you to fill the attendance list. So you can click the link that we have shared in the Zoom chat box window, and you will have to fill your summer school student ID and the module you are joining now. You are joining the module 8, and you are joining the module 8. So to all students and the instructor, this is the end of the class. Our gratitude is addressed to our instructor, Bapak Januar, and Dr. Arif Madafi Ardekani. So thank you for sharing your knowledge based on your experience, your expertise, your in the presentation before. And also thank you again for joining with us, and hope you have a good day. Thank you very much.
Good
Thank
day.
you.
So for
Thank you, UNS,
Thank
and
you.
thank you all of the participants that actually was here. So yeah.
okay, bye bye.
Uh,
So for all students.